Dividend stocks. It is one of the best ways to earn passive income, but exactly how many dividend stocks should you own? And is there a risk of owning too many or too few? Let's go ahead and break it down. Dividend stocks. They are stocks that pay dividend. That is the definition. However, what exactly does that mean? That is when a company shares its profits and its revenues with you, the shareholder. So for example, if I own one share of Coca-Cola and they pay a $5 dividend, then I get $5 for every one share that I get. That's nice, because as I continue to build my wealth, I'm going to have tens or even thousands of shares all paying $5 a piece, and that money gets deposited directly to my account. If I want it to be mailed to me with my name on it, I can also choose that option, and that is a great way to watch my wealth grow, get that passive income. I can reinvest that money too and even multiply my dividends that way if I want to. But you know, how many should I have, right? So first, let's talk about the research. So for decades, the answer has been between 20 to 30 individual stocks. Now, when I say that, I mean this is all you're investing in. No index funds, no ETFs, which I would not recommend. Okay, I would not recommend investing that way, but if that's all you did, 20 to 30 is the number that you want to have according to research. And the reason why that is the case is because you really spread out your risk. If you just own 5 stocks, if one of those 5 drops 50%, then your entire portfolio is down 10%. Okay, that's not great, because yeah, everybody's, market in 2023 was great. Some of y'all already forgot 2 years ago the market was not great. And a company like Netflix, which is doing great right now, which has been doing great for the last 13 months, was awful, absolutely awful in 2022. Okay, at one point it was down close to 60%. Nobody's talking about that now. Okay, so there is a possibility where a stock could be down 50% and it take out your entire portfolio if you only own 5. Well, what if you owned a bit more? Does that help you out? The answer is yes. Now, even though the answer is 20 to 30 stocks, I don't actually agree, especially if you are a dividend investor. And that's because this. Realistically, in real life, it is going to be very, very difficult for you as one person to research, learn, and choose 20 different stocks, get them all correct, and then over time have that be a balanced portfolio, meaning all of them are exactly at 5%. And the reason why you want to do that is because if a stock doesn't do well, or if a stock does incredibly well and it ends up being 30% of your portfolio, well, you have to know which one of the 20 stocks you should buy and sell, and how do you move that money to keep everything together? How do you manage your tax situation with 20 different stocks if that is something that's going to occur? That's going to be hard, right, with 20 different companies. And I say 20 to 30, so it could be 25, 27, 28, 30, whatever, right? That makes things very difficult. So my answer is, if that is the route that you want to take, start with 10 to 15 and then add as you go. When I mean add as you go, maybe you're adding a new stock every quarter, maybe you're adding a new stock every 6 months, which I think is probably a bit better, or you can even add a stock every year. So you're starting off with 10, you're managing it, you're understanding it, and then every year you're adding another one. Every year you're adding another. And that is going to help you for a few reasons. Number one, dividend investors aren't the type that buy and sell often. And that is because, just like if you are owning a property, you're not trying to sell that property. That's your income stream. So you are holding on to that stock usually for the very long term because you want to keep those dividend checks coming. And each year that I own a stock, I continue to learn more, right? And as I'm looking for my 11th company to own, I have an entire year to research and understand it, add it to my portfolio. Look for the 12th one. Entire year to research, add it to my portfolio. And as I age, right, next 5 years I have 15. 5 years after that, once I'm 10 years in, now I have 20, right? And now I'm at that perfect diversification level based on research. And I would have had time to do it. I would have more dividends coming in. And that would have been one of the best ways, in my opinion, to get right in the middle. You have enough to start with 10, and then you're adding more as you go along, and you're going to have a good level of diversification. Now, here's the cons of that, okay? Whether you start with 20 right now or you build it over time, having that many individual stocks can get quite expensive. So for example, let's say that you have $1,000 for every one stock. Well, you start off with 10,000, right? And then you need 30,000 as you get up to 30. Or if you want to stay at 20, you need $20,000 because you're adding $1,000 across the board for every one of those stocks, right? And that's going to be very expensive, and it's still going to be difficult for you to manage. That's the disadvantage of having too many stocks. And we've already talked about having too few. So what's the midpoint? What is the best way to get around this and still earn dividends and do so in the best, most efficient manner? Well, that is an ETF, an exchange traded fund. That's an investment that holds hundreds of stocks in one nice, neat box. And there are several dividend ETFs that are out there. In fact, it just so happens that I put out a list of my top 7 ETFs just yesterday. So I want to make sure that you check that one out, because those can grow for you just like a normal stock. And depending on which ETF you use, there are some that will pay you a very healthy dividend without you trying to choose 20 different stocks. Without you trying to find $30,000 to add to all of those stocks, you can just put in whatever you feel like into that one ETF and still be diversified. So it's a very, very good midpoint for you to check out. And that's the route that I would use. In fact, that's the route I use right now. Okay, so as I've said this many times before, I've got the majority of my money in index funds, right, through ETFs. Like VTI is one of the stock symbols there. I would say of all the money that's in stocks, we talking like 80%, maybe 85% of my money just in that one ETF. And then I got a handful of stocks outside of that I'm just holding on the side. So I have individual stocks and I have an ETF. The benefit for me there is when a company like Nvidia does well, I do incredibly well, right? But if Nvidia does not do well, if Netflix does not do well, it doesn't ruin my entire portfolio. That ETF is going to be my anchor, and then I can add a little icing on top with 5 or 10 stocks that way. And because I have 80% in that ETF, that is going to be the primary driver, because we know that that is the backbone of the market, right? And that most individual investors are very, very hard pressed to try and beat the market, and most don't. So I just have the ETF to do the hard work for me, and I just add the icing on top, which works for me more often than not. So there's the way that I would approach it. But what are some things you should be concerned about when it comes to dividends? Because there is such a thing as a dividend trap. Okay, I want you to be very careful of that. Plus, what are some of the best ETFs out there for you to check out and invest in? You want to check out these videos right here.